Ever wondered how student loans might impact your credit score? To understand this, we first need to unravel the concept of student loans. You see, student loans are often a necessary stepping stone for many in their pursuit of higher education. They're like a bridge, a financial aid that helps students cover the costs of tuition, books, and sometimes even living expenses when scholarships, grants, or personal savings fall short. Now let's talk about credit. Credit means trustworthiness. It's a way lenders like banks or credit card companies assess how likely you are to repay borrowed money. And yes, you guessed it right, student loans do play a role in determining your credit score. So student loans and credit, they're intrinsically linked. Your student loans can either be a boon or a bane to your credit history depending on how you manage them. Now that we've outlined what student loans are, let's delve into how they could affect your credit score. How exactly do student loans impact your credit score? It's a question many of us have pondered. Just like any other type of debt, student loans can influence your credit score in both positive and negative ways. When you make your student loan payments on time, every single month, you're demonstrating to potential lenders that you're a responsible borrower. This consistent positive payment history can actually boost your credit score over time. But what if the payments are late, or worse yet, missed entirely? Well, that's when things can take a turn for the worse. Later missed payments can lead to a drop in your credit score. And then there's credit utilization. That's the ratio of your outstanding debt to your total available credit. When you carry a large student loan balance, it can increase your credit utilization ratio, which can negatively impact your credit score. So it's clear that managing student loans responsibly can help maintain a healthy credit score. But what happens if things go wrong? What happens when you miss a student loan payment, or worse, default on your loan? Let's talk about two terms you need to know: delinquency and default. Delinquency kicks in the moment you miss a payment. It's like a yellow card, a warning. Your loan servicer will report the late payment to credit bureaus, and this can start to chip away at your credit score. Now, default is the red card. It generally happens after you've been delinquent for about 9 months. Once you're in default, the whole loan balance becomes due immediately. This can lead to wage garnishment, where a portion of your paycheck goes straight to paying off the loan. The government can even seize your tax refund. But don't despair. If you're struggling with repayments, seek help. Contact your loan servicer or a financial advisor. They can guide you through your options. Delinquency and default can have serious consequences, but there are ways to prevent these situations. Are there ways to manage student loans effectively and prevent harm to your credit score? Absolutely, there are. Let's talk repayment plans and loan forgiveness programs. Repayment plans come in many shapes and sizes. There's the standard repayment plan, where you pay a fixed amount each month for 10 years. Or, if that's too steep, consider an income-driven repayment plan. Your monthly payments are adjusted according to your income and family size. Then there are loan forgiveness programs. Public service loan forgiveness, for instance, forgives the remaining balance of your direct loans after you've made 120 qualifying payments while working full-time for a qualifying employer. Staying in constant contact with your lenders is key. They can provide guidance if you're struggling to make payments. And remember, there are resources out there to help you navigate these waters. Remember, while student loans can impact your credit score, careful management can turn them into a credit-building tool instead of a credit-damaging burden.